Good morning, everybody. Welcome to the Flow Show. Summer is almost officially over. Depends on what metric you use, whether it's St. Leger's Day here in the UK or Labour Day in the US, which it is today. But yeah, we're pretty much at the end, and it's going to be a busy 4 months to come till the end of the year. Morning, Kay. How you doing, mate?
Morning, Ryan. Yeah, I'm doing all right, mate. Doing all right. Already September. Time flies.
Yeah, I can't remember. It was New Year not so long ago. Here we are, the final quarter, or nearly a quarter of the year to go. Anyway, time flies these days. Right, let's get cracking and get into what's going on. Bit of data out, as you can imagine. Today, a lot of PMIs and stuff dropping, so that's where we'll start. We'll begin in China. If I can find it all the way down there somewhere. There we go. We had the main Chinese PMIs out. Manufacturing improving, but not as much as expected. Still in a negative, rising to 49.4. Services up to 50.3 as expected. So that's the official numbers there. Coming over, Australia, they also saw a small rise to 53 from 52.9. Japan, though, going backwards by 2 pips in their final manufacturing, 49.7. And then we move into the other. It's called the. This is the S&P measure, which was sponsored by Kaijing, but now that's changed, I believe. They're now sponsored by Ratings Dog, whatever that firm is, some Chinese research investment thingy. But this Canada hasn't updated it, so it's now the Ratings Dog PMI, which came in better for manufacturing at 50.5 versus the 49.5 previously to that. While we're in China, we've seen a bit of a drawdown in the fixes. They've been fixing around the 710s now, and a bit of strength coming into the yuan of late. A Chinese paper sees the yuan rising through the rest of 2025 on capital inflows. They say dividend purchase demand is expected to decline significantly after September, and the fourth quarter will see a peak in foreign exchange settlements, all contributing to a relatively strong RMB exchange rate. I don't know if you've been keeping an eye on this one, Kay, but I can't find it. Yeah, we're seeing some downside to dollar China at the moment.
Yeah, I've been speaking about it over the meetings last week. Maybe it's a sign of them to let the yuan strengthen. It's also worth noting that this is the first session, because last week I looked at it in detail. This is the first session where Asia actually started to buy gold again. Last week, Asia did not participate in the gold rally, but today clearly they did. That was what I was talking about on the Flow Show last week as well, saying that perhaps they, if you can't hold too many of your dollars anymore, they should start to find refuge in the metals again. Gold probably the lead, although we could argue that silver had a sort of much bigger rally. But it could be that they are in the process then of letting the yuan strengthen. But it's yeah, I don't know if I need to take this meeting that they had with Russia and India in the same context. It could be because that meeting is also the meeting where Xi finally spoke out about a new world order, and that could be part of letting the currency strengthen.
Yeah, could well be. We'll have to see. They've kept it pretty contained for most of this year. So we'll have to see whether they're going to start letting that go, but we shall see. The yen is also in focus because apparently, according to a Bloomberg piece, hedge funds are increasingly positioning for a potential bullish breakout in the yen. They say leveraged investors are building significant options positions that could benefit from a break through 145 in dollar yen. They report that on the 26th of August, the trading volume of dollar yen put options quadrupled that of call options. Anything you've seen on the grapevine regarding that sort of thing, Kate?
About those options on the yen?
Yeah, or just in general, any other thoughts about the yen strengthening?
Well, I mean, something that the market is probably has been waiting for the past, let's say, over a year since that drop in August last year, and look where we are. It's we're smack bang somewhere in the middle. So it's still the same question. You look at the yen crosses. They are correcting but not giving it up. You know, it's either going to be a clear sign from both Bank of Japan and the Fed, the Fed needing to start cutting more, and the Bank of Japan back on the hiking path to get the yen strengthening for longer. And but it's not only going to have to be the dollar yen. The dollar yen could actually slip a little bit more because of the dollar being on the defensive again. But those crosses, they are not giving it up right now. They are not giving it up right now. And the problem is, and in the meantime, still the same. If you're long yen, unless you go versus Swiss or so, the rest of the currencies you pay funding to be long yen.
Yeah, and it's worth noting as well that just because some of the market are putting on some decent sized hedges, it doesn't mean they think it's going to go that way. They're just protecting against the possibility of it going that way. So it's not an indicator that they're going to be pushing the market that way. Just more protection, which tends to mean that they're on the other side of the trade and they're long dollar yen. So that's one thing to keep an eye on with that. Right, jump back to the data and some of the other stuff we've had out this morning. Where are we? Where are we? Coming into Europe, we've had some of the finals and some of the firsts for manufacturing. Spain, again, another decent improvement there, 54.3 for manufacturing, blowing expectations, 52.1 out of the water. Italy, moving into expansion, 50.4. France, final, moving into expansion, 50.4 as well. Germany, they improved on their final number, but they couldn't cross the line into expansion either. So all this rain that's come is turning those brown shoots even greener at the moment. Then we had the main Eurozone manufacturing number also showing that improvement, 50.7 in the final number as well. UK, that couldn't do it either. It went backwards, 47 versus the 47.3 flash and expected number. So that's a drop of 1 whole point from last month. We did have mortgage approvals out as well, which had some better numbers, 65.3 thousand. Mortgage lending as well, up 4.52 billion. So that's ticking over pretty well. Within those numbers is the consumer credit data as well, which only went up 100 million over a revised 1.5 billion previously. So nothing really of note there either. We had Lagarde out, not too much to say, but said we will continue to take necessary measures to keep inflation under control. Right, going back to the stuff we had at the US and elsewhere on Friday, PCE numbers, which had largely been forecast and predicted as per all the CPI, PPI, and all the components therein. Came out all in line, 2.9 for the core, 2.6 for PCE, so unchanged in July for PCE, though the core went up a pip as expected. Still some inflationary pressure on there. Obviously, I wasn't around on Friday. K, still sticky, but was it a case of it didn't go much higher on Friday?
Yeah, and also the last day of the month, a bit of Yeah, I mean, yeah. But the thing is, what we've already said before. I mean, everybody has their abacus out now, and they knew sort of where this number would come out. So, and the market got exactly what it wanted to see and thought it would see. So yeah, I think it's just coming out as expected, and then we think back about what may happen in September, and it's going to be a big month and already a big week this week. So that number got shrugged off really quickly. And then, yeah, at the time of publication, it didn't really move much. We saw a few pips move, but then, as I said, the rest was the last fixing of the month, and then the start of September, where everybody now thinks that Fed will start to cut, and maybe that jobs number is going to be the one that is going to provide the proverbial final nail in the coffin to do so.
Yeah, perhaps. All that data was July data. The inflation data from the US is a bit behind everywhere else because, as you can see just above, we were getting all the final numbers for August from Europe and the like. So I believe we do have another CPI report before we get to the FOMC. So
Yes, we
that will
do.
be just as important as well. You can see there that we had the advanced good trade balance showing a bit of a worse deficit. It is a bit of a Newton's cradle situation still going on there with trade stuff. Imports, they jumped 7.1% versus a prior minus 4.6%. So there's a lot of movement going on in there. Exports, in the meanwhile, was a negative 0.1 versus a prior minus 0.7. So less of a swing in that one, but there really is some shifting going on in the activity side of things, in the import side of things. Anyway,
Well,
GDP. Yeah, go on, mate.
on that note, as I also reported already on Friday, the minimis tax where they didn't have to pay tax on or tariffs on small parcels that has dropped away from last Friday, and they have to pay now. So, in all those data, I think on the trade balance in the US, there must have been a load of front running of all those tariffs coming into place, and that's where you see a huge jump in imports. But we need to be mindful that it can completely drop away once now this tariff is in place.
Yeah, I thought we might see it settling down a bit after we had all the April May stuff on that front money, but it just seems as a bit of a Newton's cradle. We're just going to keep swinging around in some of these numbers in the import and export part. So that's probably going to continue for a while longer. Canadian GDP didn't come in that great. Their quarter-on-quarter annualised number for Q2 down 1.6%. GDP for the month of June also coming in at minus 0.1%. So growth a little bit weaker over there in the good old US. We also got the final Michigan numbers, and a little bit worse than what we saw in the flash numbers, and confirming that maybe the last 2 months have been a bit of a dead cat bounce, although current conditions did improve over the flash number, but still a negative. And those inflation expectations a little bit mixed. 1 year coming down to 4.8, but the 5 year going up to 3.4%. 3.5% from 3.4%, but still there a little bit all over the place as well. Fed's daily says it will soon be time to recalibrate policy. The Fed's inflation and labour market goals are in tension. Still thinks that tariff-related price hikes will be a one-off, and that we can't wait for perfect certainty without risking the jobs market. So a little bit dovish sounding there, jumping into Powell's line of thinking as well regarding tariff-related inflation. Fed's Cook is still clinging on. There was a court case last week, but that hearing ended without any ruling. So as far as anyone's aware, she's still in office. but that is going to keep rumbling on. And then late on Friday, the US Appeals Court ruled that many of Trump's tariffs were illegal. However, they will remain in place until October, and this is part of something that's been dragging on for a while now. Court cases against his tariffs. Is it something that doesn't or it goes against the Constitution? Congress should have the powers. Do they have the powers? Do they not have the powers? This is just yet more uncertainty regarding all this scenario as to whether Trump's tariff policies are legal or not. They already started collecting, so is that going to mean big refunds? I don't know. Kay, you got any more insight in that one?
Not more than what is said. They said in the meantime they can continue, right?
Yeah.
And I don't know. It's a bit of a cloudy situation, that one, for me at least. I do not know what to think of it right now. It will probably get challenged, and they may find another ruling in the Constitution also to get them back. But I don't see everything being reversed. No, I don't see it all being reversed, especially that some of those deals have been signed with countries. So, but what's going to come out of it, of those deals already signed? Maybe in the end Japan will be happy that they haven't put pen to paper yet on their deal.
Yeah, and if the judgment does go against Trump, he'll probably just fire all the judges and put his own ones in anyway. And then,
yeah, exactly.
He'll it. So who knows? But anyway, it's something that might pop up in headlines that might get the market wobbling. Over on the Ukraine-Russia front, Zelensky says that allies have agreed to wait until the 1st of September, i.e. today, for Russia to show its readiness for a bilateral meeting. And he expects a response from partners if Russia fails to show readiness by today. Says Ukraine wants security guarantees from allies to be ratified by respective parliaments. EU's Callas says there's broad support to expand EU military training mission to operate inside Ukraine after a truce. That won't go down well in Russia because they're still against any sort of boots on the ground as part of security guarantees. But we'll have to see what that turns out. But also, Russia have apparently been up to no good. Von der Leyen's plane, I don't know if this was reported last week or over the weekend, von der Leyen's plane suffered a bit of trouble because all the GPS services got knocked out on the ground and whatever, and the FT reporting that was down to Russian interference. Apparently they had to use good old-fashioned paper maps to navigate and land her plane. So even while they're trying to talk up about meetings and calls and whatnot to do with Ukraine, they're still up to no good elsewhere, the old Russians. That's it on the news front, as far as I can see. Just back from me jollies. Kay, anything else to add?
No, mate. I think we covered everything.
Good. Right. Well, this is it. We're in the business end of the trading season, and things are livening up this week because it's jobs week. So we're going to be getting the NFP on Friday, and it's double trouble with the Canada jobs report as well, but plenty coming up today as well. Nothing in the US because of the Labor Day holiday, so everything's sort of pushed along a day. Tomorrow we get the final manufacturing PMI and global number and the ISM number, and also Eurozone flash CPI numbers. So that's kicking off tomorrow. Wednesday, got a bit more data out of China, and it's all the services finals and others from around the globe. We also get JOLTS coming out, which lags by about a month, but it's just another insight into the labour market that we're going to get. On Thursday, we get some retail sales data out from the Eurozone. Challenger job cuts, as I say, these are usually on a Wednesday, but due to the holiday, they've been kicked. ADP, obviously going to give us our first taster ahead of that Friday NFP report. We also get jobless claims, which is well out of the survey period. for NFP, but we'll keep an eye on those anyway for a latest outlook. And then we get ISM services. So both those ISMs and the PMIs, we're going to need to be looking at the employment components amongst others, because the market will do some last minute tinkering with its expectations for Friday if there's big movements in those employment sectors or components. Friday, we get the delayed UK retail sales, hopefully. If it's not delayed again, we'll see. This was supposed to be out last week, and now it was out this week. Well done. And as I said, NFP and Canadian jobs finish off the week. So pretty busy on the data front. And as we were saying, coming into all this data, this is really, and Powell at Jackson Hole, this is really going to see the market getting its stall set out, shall we say, regarding monetary policy, not just for September, but for the rest of the year and going into the new year. Remember, markets are always looking ahead, 3 to 6 months down the line, not to what is happening so much right now. Busy old week, Kay. We can, the end of it, we can probably forget summer even existed. And it's a week till Christmas.
Very, very busy. Well, I mean, it's going to be decisive. It may actually be, I was thinking, may not, well, it seems that the market is now on board, and the majority of the Fed heads as well that they will cut in September. But maybe that jobs report, if it's really bad, may start to make the market think that they may go 50 after all. Some people saying that they won't do it because of inflation, etc. But the way that Powell spoke, it's going to have to be a really good jobs report for them not to cut, and then but if in turn it's a bad one, and let's not forget that there was this speculation that starting those September numbers, we could really see a big drop in those employment data. If we get it, the market may speculate for even a bigger cut to come.
Yeah, I'm not sure we get a bigger cut unless it's a real disaster of a jobs report. I'm talking, unemployment 4.5% minus 300k or anything like that. But I would say at the outset, just early doors, it's not so much about what happens in September. If it's a bad number, the main bulk of the moves, as I say, will be about what the market thinks about monetary policy for the rest of the year. Is it going to mean a series of cuts? We're still edging around the 2-cut mark as far as the Fed are concerned, but will we see cuts at every meeting for the rest of the year? So the last 3 meetings, will it continue into 2026? So it's more about the future than what happens just at the set meeting, which, as Kay said, looks like a bit of a done deal.
Let's not forget, we also, I think we are supposed to get more revisions for what's been happening earlier in the year. They may have been included in the ones before, but if I'm correct, that September report is also joined by revisions for earlier in the year, right? And as we know, they could be anywhere from -800 to plus 500. So, but also, and that's maybe what may be used as a bit of an excuse not to cut too much further, is that the reduction in migration may have an impact as well. So less cheap jobs also. So that may be something where the propeller heads may give us a bit of a more of an insight as well, if the number would come out completely distorted.
Yeah, and it's possible we may be stepping into the window where we start seeing those government jobs appearing.
That's what I meant about
well.
September. Those government jobs, and also some of those more private jobs. But yes, the government jobs. But in a way, we may say that those jobs reports, if they fall off a cliff, well, that should be a known unknown, or an unknown known. By how much? We know it's going to drop, but we don't know by how much and how fast or which month it's really going to show up in the data. So it's not going, perhaps not going to be too straightforward a picture, but I say to keep it very simple, look at the 50-75 line in NFP, and then unemployment rate. That's what I'm going to look at. If it goes anywhere 4.4, 4.5, which is outside or the top end, the very top end of their projections, then the market will trade it, I think. Yeah.
Yeah, exactly. And those government jobs will be a known unknown whether they come out. But one, we got a rough estimate that it's around the 300,000 mark. I'm just trying to find it because that was shown up in the Challenger numbers as well. So it's round about this was all the announced government jobs. So you're talking, as I say, these were pretty big, but there was other stuff in it as well. But we're looking around 300,000 potentially government jobs. If they show up and it's far less than that, then that will be probably a bit of a boost to the jobs market. But if we do get a wonky one, make sure, a wonky one from the NFP, make sure you're keeping an eye on the breakdown. Is it all in private or is it in those government jobs? Because they are printed out as well, same time as the NFP, as to where the job movements were. In the meantime, the nice and early, the NFP competition is up and running. I've just put the link in the Zoom chat for everyone there. Take part, to read about the prizes, the rules and whatever. And then there's 2 links in there where you need to put your guess. So that's open, up and running. We are expecting around 75,000 from NFP on Friday. So that's the benchmark at the moment. So pretty much where we were last month, unless that gets revised massively again, like the last one. But anyway, that's coming up on Friday. So have your guess in there. Right. Anything else, Kay? No. Yes.
Please, no.
No. Good. Right. Let's move on to other things then. What's going on? I'm not really up to speed yet on a lot of things. I'm just going to talk about a couple of my positions that we're in. My dollar CAD long got knocked out. I was looking for a hold above 139 or another move back to 139 last week to get my stop up. That didn't happen. But in the end, I ended up getting hit on my trailer just below this level here, 137.70. This is from my longs from down here, 135. So not a bad run. I managed to get it up near those highs. Now I have noticed coming in that where we've stopped on this drop is this important zone once again. So this is looking pretty solid at the moment. Second time of asking. However, the bounce thus far has been running into trouble at the old areas. Firstly, this 37.55, and then next up to this 75.80 area. So it's looking far more bearish this time around. We've had similar moves where we've hit this level, bounced up to that level, come down. So we may need to see the same again, maybe another test and hold down here. Then it will give it a kick up for a move back up. But the market definitely looking a bit more bearish on the dollar than it was last week, at least. My Aussie Kiwi longs, I haven't really touched this one. Was a few personal things to deal with last week, so I haven't had my eyes off the screen, but we did get a break up through 111s, up to 111.20s. I'm still short this one, looking to add, although I haven't done it in that move above 111. I'll be looking up towards this 111.40-50 area, and then maybe we're going on for a big test of the wider range up in the high 111s. That'd be another area I'll look to just add a little bit to my shorts up there. So this one's still looking very strong at the moment, so I'm just keeping an eye on that one as well. Ali, I see your short euro sterling, your core shorts. Well, I'm core long in that one still, while this 86, 85, 90 level is holding. It's still keeping it looking bullish, although once again we're finding it tough up at this 86.70 area, the top of this zone. but we are back in it after that dip to the 20s, 10s last week. But it needs to move out the top of this zone, or else the short-term picture still looks a bit bearish, but it's more turning into a bit of a consolidation, bit of range trading at the moment. So, your markers, you can probably call it 86, 87 from this point, but it needs to get above this pivot zone. If we are going out the top, then we're probably going to put in a run for the 87s and see if we can go and take on those highs. So I'm happy to stay long in this one. I'm mainly long for being short the pound because I don't like to look at what's going on with the UK. Just speaking on that briefly, I didn't add it into the news stuff, but there's been a few political position changes in the UK government or Starmer's advisors and hangers-on, including someone else that's gone in to Rachel Reeves's department, another member that a bit like Torsten Bell, who we marked up on the other week, not too good with his views about taxes and stuff. There's another tax hawk going in to Reeves's department, which won't potentially bode well for the upcoming autumn statement, i.e. the budget. So I'm keeping an eye on that. That's my reason for staying short the quid. Kay, just on the pound side, anything major note that I missed last week that changes your mind about being short the quid as well?
No, I gave up. I actually sold some euro sterling on the fixing on Friday because I thought it was like a month-end move that we had. But yeah, there was a bit of stress. Banks potentially getting taxed in the autumn budget, which, by the way, is not going to come through before November or so. Yeah, I tried to sell it, but I'm out of sterling. I don't really know what to do with it right now. But yeah, that 86.70 around is something that's been capped up to now. Could be just that if you look at that, we went down to that 86, 85.95, then back up to 70, then back up to 86.10, now back up to 70 range. 60, 70 pip range for now. But we spoke about it as well, Ali, with Ali last week. And I think if it goes through 86, 86, 85, 86, it's probably going, 86, 85, 86 is probably going to have a look back above 87, the figure. But right now, rather feeling a bit rangy. What is I'd say negative sterling. Well, yeah, what is half negative sterling is that on the latest run up in the euro dollar, sterling only followed from a distance, right? So there must be something that holds back sterling right now, and it may be that the market is not feeling too good about what is to come in the budget, and as you were saying, like this tax hawk guy coming on board as well.
Yeah, and we've got to keep an eye on these yields as well, because particularly the longer end, these 30 years, are getting a lot of focus in the UK at the moment. And as you can see, we're running pretty hot in those at the moment. I'm not saying it will, but there's a possibility we have a sort of mini trust moment, I think, with Reeves's budget when it's announced. If the market doesn't like it, I think we're going to see maybe a bit of a blow off in UK yields that will hit the quid. I'm surprised it hasn't happened thus far. So there's still a little bit of faith, it seems, from the market on Chancellor and the fiscal situation, but I think that's that option will be expiring in the next few months as far as the market's concerned. So if you're trading the quid, keep an eye on these yields as well in the UK, because despite moving the same way as everyone else, they do seem to just be moving a little bit faster than the rest. And obviously, we've got a higher yield going on there. Kay, do you think a bit of resilience in the quid is because of these high yields we're seeing? Attracting a little bit of investor attention.
Mm. Yeah, and the economic data, albeit being sluggish and far from ecstatic. Not completely falling out of bed yet. Yeah, and sterling is a high yielder in mainland now, or it has been for a while.
Yeah, as you can see there, it's pretty high. Well, looking at this, we're the only
Just look at the
country.
tens. Yeah, look at the tens and the fives. They are maybe showing something. If you look at the tens in sterling, then we're at 470, where the dollar is at 420, and Germany and etc. are quite a bit lower.
Yeah, very much so. Anyway, that's only just to keep an eye on if you're looking at the trading the quid. So yeah, good luck with your shorts, Ali. And but unfortunately, I'm the other side of you. That's it on. I think that's it. Is what I've got going on. Yeah, apart from your dollar mex, which is still knocking around down there. Still not out the woods on this one. Any news I missed last week on the mex?
No, Scheinbaum still trying to do her best to please Trump. Um, no, actually, if you look at the rest of the dollars being on the defensive, dollar max hasn't really gone even to retest 1850. Okay, so that's something to note. Because as we've seen, Mex was doing a lot better than, for instance, Canadian dollar for a while. Maybe people were just legging out of that stuff, and it's a delayed reaction we are going to get into. Mex numbers were lukewarm. One okay, the other one a little sluggish in Mexico, and that's not. I think they also. And I spoke about that last week. They're planning in their 2026 budget to quite severely hike tariffs actually on Chinese products, and they are shifting around a lot of Chinese stuff, right? So maybe the market is not overly happy with that. It had a positive reaction on the mix, but then it actually turned around, and yeah, maybe the market is not completely on board with that right now because it's obviously going to make finished products from Mexico into the US, for instance, more expensive.
Yeah, very much so. And there's asking why are people calling for 4K? Simple reason, the same reason they were calling for 2K when we were trading at 1K. People have got to call stuff. 4K is a big fat round number, and we have got a potential breakout on the cards if we go through the prior highs that we had up here. So might be a quick trip up there if we do get a breakout because it's been sat below 3,500 since the test pretty much since for the last 4 or 5 months. So yeah, that'll be a reason why it's going to break out technical. And people have long been calling for 4K in that one. But anyway, I'm sure Kay's got more stuff on that. And on that note, Kay, I'm going to pass it over to you, mate.
Sure, mate. What am I talking about? Maybe just go through the majors and see what's happening there. One of the reasons for gold being up, and been talking about it so often, is that gold is a hedge against everything that can go wrong in the world, and now there's a lot going wrong, mate. And there's still, I mean, a lot going wrong. We don't have any resolution on the Russia-Ukraine front. Now we had that meeting between China and India and Russia. China calling for a new world order. You have the outlook for the Fed lowering rates. So there's so many reasons for gold to continue higher. I must say I've taken most of mine off for now because I'm not sure whether we're going to break 3,500 straight away. I'm just keeping some really small stuff on and taking a little bit of profit on my silver as well. But because 41.5, 41.60 is going to be a big level in silver there. But I don't see anything bearish on the metals right now. Euro still okay at the top end of the range, right? Oops, I'm not in the euro. I'm in euro sterling. But the euro is having a pretty similar picture. We're at the top end of the range. Yes, we are through this little line here, 117 and a quarter, but it's more like those levels here, 117.40, stretch it to 117 and a half. It's still on the very long term. Remember that 61.8 or 78.6 of the long term that came in at that level in the euro dollar. Where is it again? It was a big level there, 112, no. Where was it? 117 and a half. Okay, I need to maybe I've put it on the daily. Oh, actually, I must have taken it out. I must have taken it out, but still, 117 and a half has been a big level all the time. Can we go higher? Yes, of course, we can go higher. It does look that at the start of the week, the market is going defensive on the dollar. We can have a bit of a yo-yo, I reckon, on those PMIs coming up. But really, we are waiting for what's going to happen on the job front now. But on quite a few pairs, the dollar is on levels that, if broken, they will be pretty big. So you've got this one here. Yes, we can argue that we will have 117.80 and 118.30 on the way up as well, but it's just breaking that range that we have been putting on here since weeks now. And if that breaks, we're probably going to have a look at maybe that famous 119, 120. But I think the catalyst will be the jobs. Okay, and as Ryan already mentioned, look at the job components in PMIs, etc., that we will have coming out as well. But the market is really in the mood to take it for a walk higher, this euro dollar cable in turn, and that is what I said last week as well. It is pushing against those levels, but without being able to break. And that is what the euro sterling did. Yes, we had that rally back up as well, but not as clear cut as the euro. For if it would have been following the euro, we would have been already back to that 135.95, 136, which is still the gateway for me to 136 and a half. Okay, but for as long as we are here, we will have to respect those ranges that we have been trading for a while now. In the current context, unless we see a comeback, we could get back to 134.90 or so. But I think we on the day with US being closed, don't expect for too much. But going further, the outside ranges have not changed. Okay, still that 133.90, still that 133.65.75 being the major one on the downside, and 135.40, and then 135.90.95 on the top side. Okay, I don't think that, apart from major US dollar news, that we will break new ground here. But I was saying some of them are showing pretty decent weakness. That's the dollar Norway. We are now through that 10.05, which on any rally from here should come in 10.05, 10.06 around, should come in as a decent resistance. And it does look to me like we may be on our way to a print in the nines. Perhaps not today with the US being off. We have already seen a bit of a move below, but now we're back above 10, which is a bit of a psychological level, obviously. But I think in the scheme of things, and then we until Friday perhaps, I guess this 10.05, 10.06 will show up. And also, and then we have to move over to what I was looking at with Frederick in our room, who brought this one up, which is a good one as well. I was seeing the very long-term dollar stocky is in testing mode there as well. Okay, that is around 937, but then here as well, you see that we are trading on the 61.8 of the 2021, 2024, 2022, sorry, rally. Okay, we are on the 61.8. We are ahead of like quite big levels on the Scandies. Okay, so keep those in mind because Scandies are one risk currencies, but also they are pretty directional. And I've always been saying like the stocky is a bit your accelerated euro dollar, right? If that breaks, perhaps that's a sign that just the dollar, it's not going to be the leading indicator, but a sign that the dollar is still on its way lower. So I would say keep those dollar Scandies not too far away from when you look at dollar moves, okay? Because they are at times quite good indicators over there. What else? I don't have much. Oh, Aussie and Kiwi. Aussie gradually pushing through. We are now through that 65.45. We were on. Actually, I forgot to update the room, but I did buy a bit again. I was long last week. I let them go on the fixing, but I bought them back this morning. Does look like we are going back for a bit of a test here. We're actually no, we're just a little below. It seems like that is also just wanting to go and grind higher. It will it remains positive for as long as we're above 2030, but also keep that 65 in mind, which always has been a level around which the market has traded a lot. If it goes back below 65, they will be disappointed by the people who have been trying to buy this break. 65.20 would be the first indication for the very short termers, but back below 65, it's probably not going to have a very good look. And the Kiwi is now following the move, and it is moving back higher. It did break back above that 58.75. Now we are trading around 59.10. It does look to be holding pretty well. So that 58.75 is now your support, yeah, to go into the week. Top side 59.20, 59.30. We need to keep an eye on, and then here, especially here, 59.60, 70. If ever this week we get a break of that, and then again it would be ideal if we get a break to see it over the jobs report, because that will be the confirmation that the jobs report was weak, and then the dollar will continue to weaken. If it goes through 59.60, 70, that's going to be another very good indication for the dollar. So it's not only the euro dollar, not only the cable, but I think those commodity currencies, dollar CAD. Ryan has already been showing there's something going on there around 137.5, I'd say. And then the Scandies as well, as we've been looking at, it is showing, okay, that the market wants to trade a weaker dollar. Close eye on silver, I think. We've already shown gold that is really still pulling higher. I would say though, and I would ask the question in gold: do we really have the strength before confirmation on that jobs report or those ISMs for gold to go above 3,500? Of course, we can go above 3,500, especially if the agents join the party again, which we have seen now. Last week, I've shown you all the action in Asia, which was absolutely zero. It was the US who were buying gold, but now Asia is back on the train. But silver here at a really massive rally, and we are now getting very close to what I think is going to be a big level on silver. Okay, 41, around 41.60. This is a weekly. Okay, this is the whole move from 2011 down to 2020. 78.6, 41.60. I think it's a big level. Okay. Yes, we can go through there if we get more weak dollar news or so. We can obviously get through there, and then we will be talking about 44, 45. Market is already having an eye if you listen to people on that 50, but okay, one step at a time, as I always say. But if you look at the global picture here, and I've always been saying, once we've broken above 35, this is really bullish. So for the longer term, okay, this is still extremely bullish, but I'd say keep an eye on what's going on if we get to up to 41 39.5. That is what I would say though on silver. Okay, any move down to start the week to around 39.40, I think is going to be supported now. This the prior high here, 39.40s, whatever. It's also a that trend line here that was broken is going to get very close to there as well if we get any retracement. So 39.40, 39.50, that's going to be your first serious support if ever we see some corrections coming up. Okay, and that's it for me, Ryan. Back over to you, mate.
Thank you very much, mate. And thank you everyone for coming to the Flow Show. We've got you geared up for the week ahead. It's going to be a busy one. So stay safe when you're trading. And yeah, we'll catch you all on Face. Oh, no Face. I better remind you of that one. No Face today because of the US holiday. So everyone will be back tomorrow. So have a good day, everybody. Take care.